You believe your home is a safe long-term investment. You assume that if a city keeps growing, your equity will grow with it. You assume basic infrastructure will always be there. In 2026, that assumption is being tested. Across the United States, some of the fastest growing housing markets sit on water systems under measurable strain, not theoretical strain, not future projections. Current documented pressure. Water is not an environmental talking point. It is an economic input. Without reliable water, you cannot expand housing. You cannot support population growth. You cannot stabilize long-term property values. Developers are still building. Buyers are still closing. But in several metro areas, the long-term math is tightening. And when infrastructure math tightens, housing markets eventually follow. Let us walk through 10 cities where water stress now intersects directly with real estate risk. Salt Lake City, Utah. The Great Salt Lake has shrunk dramatically over the past decades. That is not just an environmental issue. Exposed lakebed dust can be toxic, and it worsens air quality across the valley. Poor air quality affects public health, and public health affects labor productivity. Lower productivity slows regional economic growth. If businesses hesitate to expand because environmental conditions worsen, job growth will slow, and slower job growth means weaker housing demand. State efforts to restore water levels require funding, and funding means higher public spending. Higher public spending eventually shows up through taxes and fees. Housing markets do not crash overnight in this scenario. They stagnate. Stagnation can be just as damaging for highly leveraged homeowners. Phoenix, Arizona. Phoenix expanded aggressively during the low-rate boom. Groundwater limitations have already slowed approvals in parts of the metro area. When water certificates are restricted, future expansion ceilings become visible. Add extreme heat, rising evaporation, and the increasing infrastructure costs to secure alternative supplies. Municipalities must invest in pipelines, storage, and treatment capacity. That investment is financed through debt and rate increases. Rising water rates add to electricity bills already elevated by extreme temperatures. When essential costs rise faster than wages, affordability tightens. Affordability ceilings cap appreciation. Phoenix's risk is not immediate collapse. It's long-term compression of upside potential. Albuquerque, New Mexico. Albuquerque relies significantly on imported water tied to the Colorado River basin. Interstate water systems are under sustained stress. When allocation agreements tighten, cities that depend on transfers lose flexibility, and that uncertainty affects commercial investment decisions. Employers prefer stable infrastructure environments. If business expansion slows, population growth moderates, and moderated population growth reduces housing demand. Albuquerque has improved conservation metrics, but its dependence on a strained regional system introduces long-term volatility into what many assume is a stable housing market. Fresno, California. Fresno's economy is closely tied to agriculture, which relies heavily on groundwater. Overpumping has caused subsidence, the permanent sinking of land caused by aquifer collapse. When aquifers compress, they lose storage capacity permanently. That reduces future water availability, even in wet years. California groundwater regulations are tightening extraction. Reduced water access limits agricultural output. Reduced output affects employment and income stability in the region. When employment softens, housing demand softens. In markets heavily dependent on one industry, infrastructure strain in that industry directly impacts property values. Las Vegas, Nevada. Las Vegas derives most of its water from Lake Mead. While conservation efforts are substantial, the city remains dependent on a single major reservoir within a stressed river basin. Concentration risk increases vulnerability to federal allocation cuts. If allocations tighten further, development slows, and slower development reduces speculative demand. Meanwhile, maintaining supply reliability requires expensive infrastructure projects. Those costs flow to residents through higher rates and municipal financing. When long-term infrastructure spending rises, household budgets absorb the difference. That reduces purchasing flexibility and slows home price appreciation. Los Angeles, California. Los Angeles imports the majority of its water through complex aqueduct systems. That imported water exposes the region to regulatory decisions made hundreds of miles away. Outdoor watering restrictions are increasingly normalized. Lifestyle amenities like landscaping, pools, and green space are embedded in Southern California housing premiums. If water restrictions limit those features, perceived lifestyle value adjusts. Additionally, rising transportation and treatment costs increase municipal budgets. Higher budgets require revenue. Revenue comes from taxes and rates. When cost burdens rise, affordability narrows. Narrower affordability slows long-term housing growth. Denver, Colorado. Denver depends heavily on the Colorado River Basin, where long-term flows have declined. Interstate compacts limit unilateral expansion. Securing additional supply requires negotiation and capital investment. Capital investment means higher borrowing, and borrowing influences public budgets. Public budgets affect taxes and service fees. Housing markets thrive in stable, predictable cost environments. Resource uncertainty weakens that predictability. Predictability matters to both investors and long-term homeowners. San Antonio, Texas. San Antonio relies primarily on the Edwards Aquifer. During drought periods, aquifer levels drop rapidly. Supplemental pipelines diversify risk, but they do not expand the natural recharge cycle. Texas population growth continues at a strong pace. Growing demand against constrained natural recharge increases pricing pressure. When water becomes more expensive, it raises total ownership costs and reduces maximum mortgage affordability. Reduced affordability limits future price growth. That does not create headlines, but it creates ceilings. Atlanta, Georgia. Atlanta relies on relatively limited surface water storage for its population size. Past drought cycles revealed how close the metro has come to severe shortages. Since then, population has grown significantly. Interstate legal disputes over water allocation remain active, and legal risk creates planning uncertainty. That uncertainty affects infrastructure expansion and municipal financing, and financing changes tax and rate structures. When essential services are legally fragile, long-term investor confidence weakens. Housing markets depend on that confidence. Orlando, Florida. Orlando draws heavily from the Floridan aquifer. Rapid population growth increases daily withdrawal. Localized overdraw raises the risk of saltwater intrusion in certain zones. Saltwater contamination is expensive and difficult to reverse. If mitigation and treatment costs rise, utility rates follow. Rising essential utility costs compress disposable income. Compressed income affects rental affordability first, then homeownership demand. Orlando remains a growth market, but growth requires sustainable recharge, and that variable is increasingly monitored. Water scarcity is not dramatic. It is incremental. It raises costs slowly. It limits expansion quietly. It alters municipal balance sheets gradually. Housing is leveraged exposure to local stability. When infrastructure stability becomes conditional rather than assumed, long-term appreciation assumptions change. If you are buying property in 2026, look beyond price trends. Examine where water comes from. Examine diversification of supply. Examine rate trends. Examine permitting constraints. These are economic due diligence questions. Now tell me, have water bills risen in your area? Are restrictions becoming more common? Is new construction slowing? Drop your city in the comments. If you want continued analysis on how infrastructure constraints reshape housing markets in 2026 and beyond, subscribe. It helps this channel continue delivering grounded economic insight. Markets do not fail overnight. They weaken quietly until they do not. I will see you in the next video.